Welcome back to the Deep Dive.
Good to be here.
Today we're digging into Trimble Inc's second quarter 2025 earnings. We'll cut through the noise, look at the key numbers, the strategies, and, what it all means going forward.
Sounds good. It was definitely an interesting quarter for them.
Okay, so let's jump right in with the results snapshot. Trimble put up some strong numbers, yeah. Beat expectations.
They did. Pretty convincingly, actually. Non-GAAP EPS came in at $0.71.
Which was what? 8 cents better than consensus?
Exactly. Beat the $1.63 consensus nicely.
And revenue?
Revenue was $875.7 million. Also comfortably ahead of the streets, roughly $835.8 million estimate.
Okay, so that's 1% year-over-year growth reported, but the organic number was like 8%.
Yeah, 8% organic growth, which is pretty impressive.
Yeah.
But the number that really jumped out, I think, was the ARR.
The annual recurring revenue?
Yeah. Hit a record $2.21 billion. That's up 13% organically year over year.
That's huge. Really shows that shift towards subscriptions is working, doesn't it?
Absolutely. It makes the revenue stream much more predictable, which, investors like us really value.
And it wasn't just the top line. Gross margins look strong, too.
Very strong, 70.6% on a non-GAAP basis, up 210 basis points from last year.
Wow. And adjusted EBITDA.
Also impressive, $239.9 million for a 27.4% margin. Shows good operating leverage.
So good numbers all around.
Right.
How did the market react initially?
Pretty positively at first. The shares were up about 5.2% in pre-market trading, got up to around $87 a share.
Okay, so a nice initial pop based on the headline beat.
Yeah, suggested the market liked what it saw right out of the gate.
All right, let's unpack this a bit more then. Management really hammered home that record ARR and the connect and scale strategy. CEO Rob Painter said something like, Trimble sells productivity and efficiency. And he talked about AI and this growing data flywheel.
Yeah, that sales productivity line is key, I think. It frames them not just as a tech vendor, but as someone solving real business problems, making construction sites, logistics more efficient.
And that data flywheel.
Yeah.
That ties into the AI advantage.
Exactly. The more data they get from their systems, the smarter their AI gets, the better the products, the more customers use them, and it just keeps feeding itself. It's about building that moat.
Right. Makes sense. And you can see how these results tie back to their recent strategic moves, can't you? Like the mobility divestiture.
Absolutely. That closed back in February. It really streamlined their transportation and logistics segment.
And boosted the recurring revenue mix there, right?
Massively. It's over 90% recurring now in T&O. That's a huge quality uplift for that segment's earnings.
And then there was the PTx Trimble joint venture with AGCO, finalized in April.
Yeah, that JV lets them focus more sharply on those higher margin precision ag platforms, while AGCO handles more of the distribution. It's about focusing capital effectively.
So these moves plus connect and scale, how does that strategy actually drive the numbers we saw?
Well, connect and scale is really about integration, connecting people, the data, the workflows, entire ecosystems, really, across construction, transportation, logistics, breaking down silos.
Like bundling solutions. I think they mentioned Trimble Construction One, TC One.
Exactly. TC One bundles things together, makes it easier for customers to buy, easier for Trimble to sell. Plus, the whole push to subscription models just brings more users into the fold and gives Trimble better visibility into future revenue.
And a key piece is moving data to the cloud, you said. From machines, from on-premise systems.
Critical piece. It's not just about storage. It gives them incredible customer insights and builds that unique data set, the foundation for their AI work. That data is a huge competitive advantage.
They gave an example, didn't they? Project site management, processing drawings with AI.
Yeah, over 1.5 million drawings processed since last November. Something like 200,000 a month. Saves customers tons of manual effort. That's a tangible AI benefit right there.
And the CEO's framework for their AI advantage. Trillions, billions, millions, thousands.
Right. Trillions in construction spend, billions in freight, millions of software users, hundreds of thousands of connected devices. It's their way of saying they have this incredibly dense, unique data set across massive markets that gives them a right to win in AI. It's that data mode again.
And they're using AI internally too, not just in products.
Oh yeah. Software development, cybersecurity, sales ops, pretty much everywhere.
Yeah.
And then externally, you see it in things like natural language design and AECO, auto invoicing in their construction ERP, autonomous procurement in transport. It's becoming pervasive.
How are they making money off the AI stuff? Is it separate products?
Mostly through subscription tiers. Good, better, best, with the AI features often in the best tier, drives upsell.
Yeah.
There is some discrete monetization, like for that autonomous procurement tool, and they hinted at maybe consumption models down the line. They seem flexible.
Got it. So let's look at the segments. AECO, architecture, engineering, construction, operations. Huge ARR number there.
Yeah, record $1.36 billion in ARR, both ARR and revenue up 16% year over year.
And the operating income jump was massive. 30.4% margin, up 400 basis points.
Huge jump. Really shows that software and subscription shift paying off in margins. And they keep innovating. SketchUp won an award. Project Site is growing well with new features.
And TC One, the bundled suite.
Gaining traction. Good mix. Two-thirds of bookings from existing customers expanding, 1/3 from new logos. That's healthy.
They also mentioned focusing more on the SMB market in AECO, small and medium businesses.
Right. They see it as relatively underpenetrated, so they're hitting it harder with digital marketing and inside sales. Looks like a good growth avenue.
Okay, moving to field systems. Revenue up 3%, which seems decent given some headwinds.
Yeah, decent. They had a drag from model conversions and a tough comparison to a big government order last year. So 3% isn't bad in that context.
But ARR growth was much stronger.
Much stronger, up 17% to $358 million. Driven by things like Works Plus machine control, Catalyst positioning as a service, their core recurring software offerings are doing well.
And they're still adding hardware features, like for the PTX JV.
Yep, new guidance controller for the JV. Expanded machine guidance for tilt buckets. It's about locking customers into the ecosystem hardware enables the software and services.
So how are they convincing hardware customers, traditionally CapEx buyers, to go for recurring models?
It comes down to a few things, according to management. Affordability shifting CapEx to OpEx is easier on budgets. Technology assurance, you always have the latest sensors and software. And importantly, seamless integration back into those AECO cloud workflows. It just makes sense operationally.
And in surveying, they're trying to make the tech easier to use because of labor shortages.
Exactly. Making it accessible for non-licensed surveyors, pushing into new areas like forensics, plus innovating in drones, mobile mapping, 3D scanners, basically capturing data however customers need it and making it usable.
Got it. Let's look at transportation and logistics. Revenue and ARR both up 8%.
Yep, $133 million revenue, $492 million ARR. And remember, that segment is now over 90% recurring after the mobility sale.
So that 8% growth is pretty high quality, mostly subscription-based.
Very high quality. And they're achieving this even with what they called a stubborn freight recession. Shows their newer solutions, like that AI-based autonomous procurement, are finding traction even in a tough market. That really de-risks the segment, doesn't it?
It absolutely does. That predictability is gold.
Yeah.
Okay, shifting gears to the macro view. What did the CEO say about the overall environment?
Basically, steady as she goes. Cleaner said there was no discernible shift in sentiment or in-market performance from Q1 to Q2. Opportunities still outweigh uncertainties, was the message.
So not getting worse, but maybe not accelerating rapidly either.
Seems that way. He highlighted specific strengths, though: energy infrastructure, defense in Europe, data centers, civil infrastructure, energy in the U.S., India, Middle East, also strong globally.
And construction backlogs are generally healthy, transportation stabilizing.
That was the sense, yeah. Construction customers mostly have work lined up, and the transport market, while still tough, isn't falling off a cliff. Seems to be finding a bottom.
That diversification helps them, right? Across geographies and end markets.
Definitely provides resilience. A couple of policy points worth noting, too. Tariffs are still hitting COGS and field systems.
About $10 million a quarter.
Yeah, but they've put surcharges in place to offset it, apparently.
Okay. And the other thing was Section 174, the R&D tax change.
Right. The repeal of that came in that one big beautiful bill, as Painter joked.
And that's a cash flow benefit.
A significant one. About $50 million expected in 2025, $80 million total over time. That's a nice little tailwind for cash flow.
And capital allocation. Still buying back stock.
Yep. $50 million in buybacks in Q2. They expect to use at least a third of free cash flow for buybacks long term. Plus, still doing small tuck-in acquisitions like Trimble Materials to add capabilities. Disciplined approach.
Okay, so pulling it all together, they raised the full year outlook.
They did. Raise revenue guidance to $3.48, $3.56 billion. And non-GAAP EPS now expected between $2.90 and $3.06.
So midpoint, up $100 million on revenue, 21 cents on EPS. That's a confident raise.
It certainly signals confidence. And for Q3, they're guiding revenue between $850 and $890 million and EPS between 0.67 and 75 cents. Solid continuation.
And they reiterated that big target, $34.30 by 2027.
Right. $3 billion ARR, $4 billion revenue, 30% EBIT margin. That's the North Star they're aiming for. And this quarter reinforces that path, shows a clearer route to structurally higher margins.
So for you, the experienced investor listening, what's the main takeaway here? Strong momentum.
Absolutely. Consistent beat and raise, record ARR. It screams solid execution on their strategy. That shift to subscription and software is clearly working. You see it in the margins. That's exactly what you want to see for predictable high margin growth.
And the strategic moves, the divestiture, the JV seem to be paying off, focusing them on the right areas, plus buybacks. Shows good capital discipline.
Totally agree. Now, what's fascinating, as we touched on, is the market reaction after that initial pop.
Right, it faded. Closed pretty flat on the day.
Yeah, closed at $84.13, basically unchanged from the previous close of $84.25, despite the strong results and the pre-market jump.
Yeah. So what do you make of that? Was the good news already baked in? Or maybe broader market jitters?
Could be a bit of both, you know? Maybe expectations were already high, or perhaps the market is still cautious about the macro, despite management's relatively steady commentary. For a long-term investor, though.
Yeah, for you looking longer term, the intraday noise maybe matters less than the underlying story. The AI focus, the cloud workflows becoming indispensable.
Exactly. That's the core narrative. Trimble is positioning itself right in the middle of digital transformation for huge industries. That connect and scale strategy, leveraging that data moat, it's a powerful story for sustainable growth.
Plus, you've got tailwinds like strong state DOP budgets for infrastructure.
Right. And their global reach adds resilience. That 34/30 target gives you a clear roadmap to track their progress.
So looking ahead, what are the key things to watch? Q3 results, obviously.
Q3 execution is key. Also, any signs of bookings picking up from infrastructure projects, more proof points on AI features actually driving value, and crucially, continued margin expansion as that cloud mix keeps increasing.
Okay, makes sense. Now, let's shift to our not financial advice segment. Time to get a little creative.
All right, let's brainstorm.
So, given everything we've discussed, the recurring revenue shift, the AI push, the whole autonomous construction trend, here's a thought. What about a long position in Trimble, TRMB, but maybe structured with options, like a collar?
Okay, interesting. How would that work?
Well, what if you bought some longer dated calls, say 18 months out, maybe 15% out of the money? Captures that long-term upside from ARR growth, AI taking off, hitting that 34/30 target.
Right, captures the big picture potential, the multi-bagger story, if that autonomous vision plays out.
Exactly. And then to fund those calls, or at least reduce the cost, you sell some shorter dated puts. Maybe 6 months out, 10% in the money.
So the in-the-money puts give you some immediate downside buffer, hedging against near-term wobbles, maybe if Q3 guidance is a bit soft, or the freight recession lingers.
Precisely. It's a way to play for that significant long-term upside from their transformation and AI leadership, while acknowledging things might be bumpy in the near term. It's aggressive, sure, but calculated. Leans into the value, but respects the uncertainty.
I see the logic. You're basically trying to get leveraged exposure to the long-term story while defining your near-term risk. Definitely not standard advice, but an interesting structure to think about.
For sure. Okay, let's wrap this up. To recap, Trimble Q2, a very strong quarter.
Yeah, beat expectations pretty much across the board. Record ARR, good execution on connect and scale.
They raised the full-year guidance, reaffirmed that ambitious 34/30 by 2027 goal. Lots of confidence there.
Fueled by those smart portfolio moves, the buybacks, and that accelerating focus on AI.
And while the market's immediate reaction on the day was a bit muted after the initial pop,
the underlying fundamentals, the operational strength, the long-term catalysts, they still look pretty compelling for you if you're watching this space.
Absolutely. Well, thank you for tuning in to The Deep Dive. Remember, this isn't financial advice. Always do your own research and consult with a professional.
That's right.
We'd love to hear your thoughts on Trimble or today's deep dive. Until next time.